Good evening, everyone. I, CA Gyati Gupta, a practicing chartered accountant from Meerut, wholeheartedly welcome you all on the behalf of Committee of Financial Markets and Digital Protection. Hoping our audience to be in pink state of health. I welcome you all in today's webinar, which is based on risk management in equity trading and investment, and it will also cover the aspect of long-term investing using business principles. Let me quickly invite one of the most respected and revered chartered accountants of our fraternity, the chairman of this committee, uh, and he also chairs the Committee on Information Technology of South Asian Federation of Accountants, which is known as SAFA. And he is also the head of Digital Accounting and Assurance Board, ICAI. He is a brand in himself. He needs no further introduction. His name is enough. And let me introduce CA Charanjot Singh Nandaji. Sir, over to you.
Yes, Gayatri, should I start?
Yes, sir.
So very good afternoon, very good evening, ladies and gentlemen. CA Ghanshyam Joshi, CA Atharv Apte, the learned speakers of the day, Madam Gyati Gupta, the moderator, Gaver PD from the board who takes care of the initiatives, Ashok, and all members who have come here to go home more enlightened. Ladies and gentlemen, my compliments. The market is nearing its all-time high. Rather, it is at its all-time high. And this topic is very pertinent at this time. Markets at top. Whatever you buy, you are getting money out of it. So all people have become market gurus, all have become experts. So in this time, you need to understand what is risk management. You need to understand how you can make investment in a business-like way. Three very important things which I would like to discuss with you. Number one, in market, losses are inevitable. We as professionals have to shorten our losses, curtail our losses. Let them not go unabated. Second, be disciplined. The market calls for discipline, and people who are indisciplined are punished severely by the market. And third, and the most important thing, try to create value and worth by this market. एक बहुत उम्दा बात लोग कहते हैं कि बाजार में लखपति बनना बड़ा आसान है, provided आप पहले से करोड़पति हो. Some people say, if God was to confuse human minds, he could not have invented something better than the trading terminals. We professional chartered accountants have to belie all these beliefs. The council, in its wisdom, has allowed chartered accountants in practice to indulge in derivative tradings in calls and options in equity and in currency markets, currency segments. So now it is time when we start creating value and worth by investment in markets. I have a very strong view. If one wants to become a multi-millionaire by legitimate means, the only option is market. So, ladies and gentlemen, we have invited two of the best of the speakers, Ghanshyam Joshi ji and Atharv Apte. Both of them are the members of the institute. The moderator also is a member of the institute. So all of us have to put our heads together and create an environment where we understand how to invest, and more importantly, how to keep our risk management at the top level. Risk management is our appetite, but how much we have to live upon that, how much calculated risk we have to take. This today's session will signify. I will not speak much, but I will end with a couplet, and the couplet says, देते न थे जो जवाब उनके सलाम आने लगे, देते न थे जो जवाब उनके सलाम आने लगे, वक्त बदला तो मेरे नीम के पेड़ पर आम आने लगे. So for bulls, नीम के पेड़ पे बहुत आम आ रहे हैं, उसकी खेती करें, create a capital and enjoy your life. So over to Madam Gyati Gupta for her further proceedings. Gyati ji, the dice is all yours now. Thank you.
Very well said, sir, for your words of wisdom, and it is always a pleasure to listen from you. Let me quickly introduce the first speaker of our day, who is C. Ghanshyam Joshi ji. He is from City Nasik, and he is currently the member of Capital Market and Investor Protection Committee of WIRC of ICAI for the year 2022 to 23. And coming to his educational qualification, he has pursued BCom, FCA, and Diploma in IFRS from ACCA UK. And also, he has also pursued certificate course in fundamental and technical analysis, including equity research from ICAI. Coming to his work experience, he has worked as a controlling head, internal audit head in MNC companies like EPCOS India and SKF India. And in 2007, he was selected by EPCOS for IFRS training at Singapore for changeover in reporting from US GAAP to IFRS. He has also worked as accounts head in Mahindra Sona Limited. And during the service, he had implemented the requirement of Companies Act 2013 and Ind AS first time adoption. He has been in practice since 2017. He was earlier in partnership and now he is working as a proprietor. He has delivered lectures on fundamental analysis and technical analysis at various forums like Conclave on Capital Markets at Dule branch of WIRC of ICAI, Faculty Development Program of NMFC in collaboration with WIRC of ICAI, and Association of Valuation Professionals, etc. So we welcome you. You are warmly welcome to this platform of Chartered Accountants, and our audience is certainly looking forward to have many valuable key takeaways from your session today. Over to you, Ghanshyam sir.
Thank you, Gayatriji, for the nice introduction, and thank you, Charanjot sir, for the opening remark. You are very
Always,
much.
Ghanshyam bhai, we always glad to listen to you. Your words of wisdom go a long way in advising our members how they have to create value and wealth.
Okay,
Thank
sir. Yeah. So taking forward, I am starting screen sharing. So screen is visible. Yes.
Yes, sir. Visible.
Okay. So today's topic, my topic is risk management in equity trading and investing. First of all, these are the standard disclaimer. This is what I am sharing. This is for study and educational purpose only. I am not a SEBI registered advisor, so no investment advice or no trading calls given in this webinar. And eventually, if I take any name of any company or any stock, that is for just example purpose. Yeah. Do your own research. Take advice from SEBI registered advisor before investing. Sites used are for information purpose only. There is no paid promotion for this, and whatever I'm using the sites, these are free sites available to anyone. No stock specific query because I am not a SEBI registered advisor. You can connect me on Twitter and DM is open. So my Twitter handle is given on in the slide. Yeah, you can note down it. And if you have any further query after the session, you can DM me. Then, what are the learning objectives today from this session? The risk. What is the risk? And how to manage that risk? And if we use some system tools which are available at free, then how it will be? Note down your questions, note down your queries, and ask the queries at the end, because it might be possible that your query might be get answered in my next slides. So starting the today's presentation, what is the risk? Risk is a crucial aspect of share market, equity market, financial market. Yeah, there are variety of risk factors involved in this. If we go summarize them, then first is market trends. If suppose just make a use. Market is trending, somehow something happens, and that is market trend risk. You invested here, you got the rally up to here, and from here the market is going down. What you have to do in such situations? That is called the market trend. Then economic condition, whether our national GDP is increasing, whether world GDP is increasing, and our budget allocations are in line of the GDP, then company performance. Suppose you have invested in a particular stock and that company is performing very well, sales is going up, profit is also going up, and suddenly something happens and the profit comes down. The sales is not came down that much. Then analyze here what is gone wrong here and take decision accordingly, whether you have to stay invested in that company, that stock, or you have to get out of that stock, because in market there are numerous opportunities are there. So don't marry a stock, keep the stock in your portfolio until that is giving you a good profit. From top, you, if suppose that stock is trading all time high, you are entered here, suppose at 100 rupees you are entered, that stock has gone up to 500 rupees, you are on 5x profit. Give some leverage here. Just if suppose 10-20% is corrected, then there might be chances it has from the top level it is profit booking is came, and it may consolidate here and it may go down. After that, you may think whether I have to continue in that or I have to book my profit. So 20% of 500 comes to 100, then your stock value is 400. So 100 to 400, you are on 4x profit. At the time, you think whether I have to take my profit, I have to book partial profit, or I have to recover the cost and let the profit run, that type of risk. Then geographical events. See, in last year, we have seen this Russia-Ukraine war. At that time, market was corrected, and then again, market has rallied. There are talks that America is or Europe is going into recession. Let that come and then think whether the recession is seen in our economy or not, and what is the impact of that recession on our stock portfolio, our companies, the stocks which we are holding. Check that and then take the decision. Now, before investing or before trading, decide who you are, what type of investor you are, identify yourself. Are you a scalper? They may hold the stock for intraday purpose only or for 2-3 days, and as soon as they get a profit of the target, 1:2 risk reward or 1:3 risk reward, they get out of that. So identify who you are. If you are a swing trader, swing traders generally hold the stock from 2-3 days to 7-10 days, or sometimes if the stock is going high, then they may trail that. Positional traders, they normally hold the stock for 15 to 30 days. Short-term investor, they hold the stock for 1 month to 24 months, and medium to long-term investor, they hold the stock for more than 24 months to undefined period. So first of all, identify who you are and at what level you need to exit from the stock. Okay? Then after that, see, now you have taken a position in a stock, you have taken an entry. Yeah. And thereafter the stock is in correction mode. So up to what level you have to stay in that, you have to think. Suppose your entry price is 100 rupees stock corrected for 10%, then the market price will be 90, and to come again to your entry price, that stock has to rally another 11%. If that stock is corrected for 20%, so the current market price is 80, and from 80 to 100, that journey will be 25%. If that stock is corrected for 25%, then the upward journey to reach your entry price, that should be 33%. And if that stock is corrected for 33.33%, then it has to perform 50% upward journey to come at your investment level. If that has corrected for 50%, then it has to run 100%, means it has to double from there, that current market price, to reach at your investment price. If suppose that stock has corrected 80% and you didn't exited within a particular time from that stock, the CMP is 20, and that stock has to run 4x time, 400% from here to reach your investment level. So think wisely and decide your entry and exit point. So now, why risk management is important? Almost all of us has heard about चक्रव्यूह. अभिमन्यु चक्रव्यूह में गया था. चक्रव्यूह में जाने का रास्ता उसको मालूम था, पर बाहर निकलने का रास्ता नहीं मालूम था. Stock market is like that. Many people find it very easy to enter into any stock, and it is very difficult to exit from the stock. If suppose that stock corrected 20%, general psychology of the human, this according to that general psychology, what they think, मेरा भाव कभी ना कभी तो आएगा, आज नहीं तो कल आएगा. But what about your time value of money? What about your risk management? It may go on a toss. So according to your risk appetite, place a stop loss and exit from that stock, and go and invest in a running stock. So taking another example, suppose this is hand of a worker. He was working on a machine, and his machine got into his finger got into that machine, and this part of the finger is ruptured. Okay, that person goes to a doctor. He tells the doctor that, doctor, you are a very brilliant doctor, just treat me for this. Doctor says him, see brother, this has been ruptured and we have to cut this part of finger. That person says, अरे नहीं सर, अगर मेरी उंगली का थोड़ा सा पार्ट आप काट दोगे तो मेरा अंग भंग हो जाएगा, फिर मुझे मेरे रिचुअल्स में, मेरे पूजा पाठ में मुझे दिक्कत आएगी, मैं रिचुअल्स नहीं कर पाऊंगा प्रॉपर्ली. He tells that doctor that you give me medicines, you do the first aid, you do the bandage, you do the operation, but don't cut that finger. Meanwhile, the doctor tried to convince him, but he doesn't listen. Doctor gives him some medicine, he do the first aid, and within few days, after giving the medication, that finger starts developing gangrene, and this much part of the finger is now need to be amputated. इतना कट करना पड़ेगा to save his hand. Then again that worker says to the doctor, no doctor, you are a very genius doctor, I have faith in you, you can treat me with medicine, don't cut my finger. Then again doctor हतबल हो जाता है, वो उसको मेडिसिन देता है. Then that gangrene starts going deeper, and that go to this level, and then that goes to this level. Now the doctor says him, brother, now listen seriously, You have to cut this whole finger earlier. This one part has to be uh, amputed. Now, hold this finger. We need to cut, hold this finger to save your hand. Again, that person starts arguing, no, doctor, I am faith in you. I have faith in God, and you are a God, and you can save me without cutting the finger. And eventually, that gangrene starts going into the palm, and all this area, this gets started, gangrene goes up to this level, and now the doctor says him, now it's the time, either we have to cut your palm or you will lose your hand. And then that person says, okay, now I do not have any choice, please save my hand and cut the palm. If we do not place our stop losses, if we do not cut our losses on time, this situation may occur in our practical life for our portfolio also. So that's why risk management is important. So it is essential for all the investor to have a well-defined risk management strategy that can help them mitigate the potential losses and maximize return. If suppose you cut the loss at the early stage and you keep your runners running and you cut your losses at early stage, what will happen? Though your winning rate means your how much trade you are taking and how much trade are going in good profit, that rate is low. Suppose that rate is 50 is to 50%, winning 50, losing 50, or 40 winning and 60 losing, then also you can make a good amount of money if you cut your losses on time and you let your runners run. So it is very important for us to mitigate the risk. Now, how to mitigate the risk? There are some common tools. Some persons use the moving average prices. What moving averages depict? Whether the stock is going upside, whether that stock is in a trend or it has changed the trend. So based on moving averages, you can define your stop losses. Suppose you are a short-term trader, you are a scalper, you are a day trader. If you are a day trader, as soon as the 7-period moving average on your chart, which time frame you are using, that is crossing down 10-period moving average or 20-period moving average, immediately cut your loss. So 7-period crossing down 20-period or 7-period crossing down 10-period. At that time, cut your loss. If suppose you are a medium-term investor, then don't look at intraday time frame chart. See, just you go through the at least a daily time frame chart and take a decision based on that. If suppose the price is coming down and it has crossing down the 20-day moving average, then cut your loss. If suppose you are an ultra long-term investor, then look for the weekly and monthly chart. If on weekly chart the trend has reversed, then take a decision at what level you have to exit from the stock. So clear this is? Then some people take the decision based on RSI. If suppose RSI has gone up, 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 up. Earlier this RSI was here 50, it has reached to 70, generally it is said that 30 is oversold zone and 70 is overbought zone. But when it goes above 70, if there is a strength in that stock, that will go up. That RSI may go up to 90-95% also. And then when it is reversing, and suppose that came down after reaching 95, that RSI came down to 85, then you may think for either partial profit booking or full profit booking based on your risk appetite. If suppose that RSI gone up to 80 and then it is reversing, it has crossing down 70, then book partial profit here and then take a decision. If that is not going up, instead of going up, it is further going down, then you can cut the position. So this is one strategy. You have to choose the strategies based on your analysis, based on your risk appetite. Now trend lines. Suppose this is the upper trend line and this is the downside trend. This type of pattern that stock has made, and the prices moved like here to here to here to here. You have taken entry at this level. Okay. What it suggests now, if this price cuts this trend line and goes up, then there are chances that it may go further up. And if suppose this stock cuts down, crosses down this trend line and going down, then what will happen? There are more chances that it may either take support at this level, or it may go down and take support at this level, or it may further go down. Now you have to define your risk appetite, whether you want to stay up to this level, wait and watch, and if that is turning up, then well and good. Otherwise, you have to cut your losses here and get out of that stock. Then some people follow the patterns. Suppose that stock made a inverted head and shoulder pattern and going up. It has retested the neckline of that pattern and going down, means this was a fake breakout. If there is a volume on this breakdown, then take a decision at what stop loss you need to exit from that stock. See, अगर वो स्टॉक यहाँ से ब्रेकडाउन दिया है, वापस अगर ऊपर जा रहा है, किसी ने आपको रोका है क्या वापस यहाँ पे एंट्री लेने के लिए? नहीं ना, हम वापस यहाँ पे एंट्री ले सकते हैं. वी कैन टेक एंट्री हियर एंड अगेन राइड दैट, बट डोंट स्टे इन होप मेरा भाव आएगा. ये चीज कभी मत करना. डोंट फाइट विथ द प्राइस एक्शन. Price action and volume, these are the prime things. Based on the stock prices moves, and all other indicator, oscillator, all these things comes later, because all the things are based on price action and volume. If suppose that stock made a cup and handle pattern, it is going up, but it has retested again the stock, this breakout level, and again going up, you can stay in that. If that breakdown and it has breached this level also and going down, then take a wise decision to get out of that. Again, when it comes in strength, you can enter. Suppose this is a W pattern. We have heard in a movie, W के नीचे बहुत पैसा है. Double bottom it had created and going up. Now first target will be after this. What is the distance from this neckline to this first bottom? That will be your first target. So if that stock is going up, stay in it. If that is going down, get out of it. So based on pattern, there are lots of patterns. You can follow the pattern theory and properly execute your trades. Some persons take the Fibonacci ratio. Fibonacci, if that 38%, if that is reversing from 38%, it is crossing 50%, and it is crossing some 61%. So when that price comes down and taking a support at 38% level and going up and it crosses 50%, then there are chances that it will cross the 61% and it may go up. If instead of that, before reaching 50%, it is going down, then don't stay in that for a long. If you can short that stock here. Then most important part, if your capital is used, then apply the hedge technique. Hedge your portfolio by buying. If suppose the market is going up and suddenly market has started reversing, you are all stocks you hold, these are fundamentally strong, the companies are doing well, but because of overall broader market condition, the stock is getting corrected. So in that case, you can buy a option, put option, buy a P and hedge your portfolio, or you can short sell the future and hedge your portfolio. So depend upon what type of investor you are, you can take this decision. So your profit get protected. When the overall market is coming down and your stock price is coming down, at that time, hedging may give you a comfort, and whatever loss you are incurring in this in your portfolio, that may be covered with this put option, or part of that loss is covered with the put option or short selling the future. Now, just a minute. Yeah. If suppose you are using moving average prices, or you are using some other indicator oscillator as your stop loss, how can you manage that? See, for a professional person, it is not possible to day in day out monitor all the charts of the portfolio. So what can you do? This is a free website, charting. Create a watch list. I will explain how to create the watch list and how to create the dashboard to monitor your portfolio in the next slides. So create a watch list of your portfolio. Then create a dashboard and manage your portfolio with the help of the dashboard. Visit the dashboard at regular interval. If suppose you are a short-term to medium-term investor, look at it at least daily, once daily at 2:30 p.m. Or if you are a long-term investor, at least look it at once in a week at the weekend. What movement it has given and all the things. So visit the dashboard at regular intervals. Short-term wala daily at 2:30 p.m. and long-term wala at weekly intervals, and monitor your stop losses based on your predefined strategy. So how to create the watch list? This is the charting. On charting, you have to create your login, which is free, with your login mail ID. You can create a login and go to here. This is the home screen. Yeah, on home screen, this part will appear. Go to here, dashboard, scan, watch list on this. After clicking this watch list, this screen will open, and I have created already lots of watch lists for my tracking. So I had hidden their names. You can click here then to create a new watch list. After clicking there, create a new watch list, this screen will open. So in this screen, give here a name. I have created a watch list for today's webinar and given a name of test watch list, risk management. Define this name, then define this description. If you have further strategies, if you can further view the your strategies in this description. So when you are going to apply your stop loss and all these things in this, and then save this. So your watch list will be saved. Name of that watch list will be saved. Then after creating that watch list, make it as a default watch list. If you see here, default watch list for scan or for wages means for dashboard. Click here and set it to yes, and then add stock by clicking here, add view stocks. Then you can add the stocks in your watch list. So after clicking on that, add stocks or view stocks. See, if suppose I'm creating altogether a new watch list, I am first, I have two options. Either I have to manually punch all the search for all the stocks and select individual stocks and create a watch list, or if I have the NSE codes, BSE codes, ticker codes, then create a CSV file of that ticker code and you can upload that file from here. Then if you are going to upload the full file, CSV file or text file, then you have to choose file from here, go to the location, then select that file, and then you can upload the file. So in one go, you can upload all the stocks. The alternate method, if you are not comfortable with the uploading file, then you have to give the name here, then click on this search button, then the name will appear. Select this name and then add select, click on this add select. After select, clicking this add, pressing this add select button, one dialog box will open here, and then press OK on the dialog box, and then that stock will be added in your stock list. So if suppose you have to select one stock of Tata, you have entered here Tata and search, you have pressed the search button. So all stocks of Tata will come here. You can scroll up down and particular stock that which you have to select, click on that and then click on this add select and select OK. Then your watch list will be expanded as this. So this is the dialog box. You have to press OK here, then that stock will be added to your watch list. I will take a practical example of this, and all these shares will be shown here. Earlier, before selecting Tata, there were 4 entries in this watch list. Yeah, this is a sample watch list. Don't, I am not recommending these stocks. Just how to, these are randomly picked based on how to, for explaining how to create the watch list. Yeah, earlier there was 4 stocks. Now after selecting the Tata Consumer Products, now there are 5 stocks in the watch list. So you can create the watch list like this. Then now after creating the watch list, we have to see the dashboard. How to we have to create the dashboard. Now how to create the dashboard? On the home screen, this will appear. So click on these dashboards. After clicking on these dashboards, you will get a screen like this. I have already created some wages, some dashboards in this. So these names are, these dashboards are appearing. If you are new and you have not created any dashboard, then this section will be blank. So then go here and click on this create new dashboard. After clicking that, this dialog box will be open. Give appropriate name and given a test portfolio risk management name here, and then save this dashboard. After saving this dashboard, let's take, yeah, after saving this dashboard, that dashboard will come here, and then you have to go to that dashboard, open it, and now you have to define the filters here. First, after going into it, you have to first define the filter. In filter, by default, this condition will come stock passes all of the below filters. Here, some name will appear, either watch list or Nifty. You have to click here and select the name of your default watch list here. So you have to make this setting, and then you have to go to this columns setting. Now, in the columns, you can select here, just this button will appear here. You click on this and you select name. You need not have to select name of the stock, because that will pick by default. So I need close price, so I choose here. I clicked on this plus mark and I choose close. Then here, like this, column 1, column 2, that type of name will appear. We have to manually change this name. So I changed to this price, then I selected percentage change, clicked on this and selected percentage change, and then renamed it to percentage change. Then I selected RSI and renamed it to RSI daily. See here, latest means daily. You can change this to weekly, monthly, as per your requirement. Then latest SMA. This SMA means, the SMA stands for simple moving average. If you are using simple moving average, then you can select here simple moving average. After selecting simple moving average, this dialog box will give you the latest close. By default, there will be some value here, and which value, how many days moving average you want. So put there that number. See, edit that and correct to that number. So I choose on the 10-day moving average, 20-day moving average, 50-day moving average, 200-day moving average, and accordingly renamed these column headings. Then I choose on max function. Max, I need a 52-week high of that stock, and I need a 52-week low of that stock. What is the 52-week high and 52-week low? So I choose the max function, and I edited this latest to weekly. So do this, and then we need a 52-week. So edit this number to 52, and again this will come. If you click here and edit it to from latest to weekly, here if you edit this latest to weekly, then by default this will come to weekly, and you have to select this high, low, close, whatever you want. I need here 52-week high, so I selected high and renamed this column to 52-week low. Now what this button is appearing, if we click on that button, then some colors will appear there. So for 52-week high, I selected green color, and for 52-week low, I selected a yellow color. Then suppose I am ultra long term investor. I need a SMA, but I need monthly SMA. And what period? 12 months SMA. So I choose an SMA monthly close and 12 period SMA. Likewise, and you can use bracket functions. So I have to calculate what is the percentage change what is the difference between monthly SMA 12 and latest close. So I start this function with bracket, then latest close, I choose the close divided by monthly SMA. I change here monthly, and here it will come by monthly close 12 into 100 minus 100. So this will give me a in terms of percentage, what is the difference between 12 SMA and latest close. So after that, I will take a practical example also, how to define this. After defining all these parameters, then you have to click on the save button. When you save this, then this below what is this appearing here, this dialog box will appear here now. In this dialog box, you have to give the name of the dashboard, define the name and define the description of the dashboard, and then click on this submit button. So now your dashboard is ready to use and you can use that dashboard. After that, if you go to your dashboard from this home screen, this type of dashboard will appear here. So we want all these columns to be visible. So then go to this edit layout, and after pressing this edit layout, this will turn into gray, and here 3 dotted, 2 dotted and 1 dotted line will come. If you drag that, then this will expand. So let's go to the charting website. So here is the watch list which I have created. Now we will add some stocks here. Suppose I want to add here Hindustan Unilever, or suppose some stock starting with Hindustan Aeronautics Limited. I chosen this Hindustan Aeronautics Limited here. See, in this search box, I press this search button. As soon as I press this search button, stocks which contains the Hindustan, these were appearing here. I selected Hindustan Aeronautics, and now I will add this, and there one dialog box will appear here. I will click on OK, then that stock will be added to here, and these stock entries will become from 5 to 6. Let's see how that will function. So I chosen this Hindustan Aeronautics. Now I will press here, add select. This dialog box appeared here. I will press OK here. After pressing OK, that stock will get added here. Now Hindustan Aeronautics, this stock added to the watch list, and this is sorted on stock names. Okay, you can change the sorting criteria either on symbol or on percentage change or on close value. Good going till now? Yes, no?
Yes, sir.
Yeah, okay. So after adding this, now I'm going to dashboard. See, I explained up to this level how to go there. See, I will go to the home screen first. After logging, starting this charting, this screen will appear. from this screen, you have to select on this dashboard. Oh, sorry. You have to select this dashboard, click on this dashboard, and then you will go to that screen. I clicked here dashboard. For the time being, close your eyes because I have a lot of dashboards which are not useful for you. So I have created this test portfolio. And when I clicked on that, then you have to go here, and first of all, you have to go on to the filter and select the appropriate watch list. Yeah, here this watch list is created. I am selecting this watch list and I run this. So that results are showing here. I am going to the then column designing. See here, by pressing this add columns, multiple options are opening here. As I'm moving the cursor, whether these various fields are getting highlighted, yes, no? Madam? See, now my cursor is on symbol. Whether symbol is getting highlighted?
No, sir.
Not visible. Okay, if you move your cursor on these fields, so you can check what you want. Otherwise, simply if you are familiar with the fields, click here CLOS, type here close, and here options related to close will appear. Now I'm selecting the close, and here appear the latest close. I can change this latest close to 1 day ago close, 2 day ago close, or n number of days ago close.
Sir, sorry to interrupt, but your PPT is only visible. The cursor is not visible.
Just a minute. Okay, now charting is visible.
Yes, sir. Yes.
Okay, sorry. See, after logging into charting, this dashboard, this button, now the cursor is on dashboard. It is visible.
Yes, sir. It is visible now.
Yeah. So you have to go to this dashboard. After going to this dashboard we have created just now. So I am going to this dashboard. After going to this dashboard, this type of screen will appear. Yeah. I have to go to here on the edit button. Clicking on this edit button and then going to filter, I will select our watch list. Test watch list, risk management. Then I will go to these columns. I will define these columns. Now, see here it is latest. I can change this latest to weekly. Now the drop down list is appearing here. And as I move the cursor, whether it is highlighting now weekly, yes, no?
Yes, sir.
Yeah. So if I want weekly close, I will go to weekly. I will select weekly. If I want 52 week ago close, I will change here. I will go here on n week ago and edit here 10 to 52, and I press OK, then it will change to 52 week ago close. But for the time being, we need latest close. Yeah. So latest close, and I have to rename this to price, and this filter, this change color, column color, if we apply this, then there are some color options are there, and we can select color as per our choice. Then I selected close, I selected percentage change, then I selected latest RSI, means all these parameters on daily basis, and these two parameters on weekly basis. I will show you practically how to use the minimum and max function. I'm going here, I'm selecting here max. I need a so max duration value. If I just click that, here latest max 20 number 20. So what it depicts, it is the latest max for 20 and number 20. Do we need here number? No, we need high. So I change this high. Now, if suppose I'm checking on daily basis, then I can put here 252 days, which are approximately number of working trading days in a year, 252. So latest max 252, latest high. And now I can change this column from weekly high to 252 day high. Okay. And this bracket function, if I start using this bracket, I will just in this selected measures, I will type BRA. So this bracket will appear here. Then from this number, I will change this number to close, latest close. Then this is the operation button. By clicking on this quadrant, I can get this operation. I want latest close to be divided by high. Which high? I don't need. Okay. 252 end day ago high. So sorry, not like this. I have to choose after bracket. Yeah. Latest close, that is divided by monthly SMA. So I will go here and I type here SMA, which is depict for simple moving average. And I will change this to monthly SMA. And as soon as I changed here from latest, earlier it was latest. And with this latest, here also it was latest. Now I will change this latest to monthly. As soon as I change this to monthly, this is gone change to monthly. Okay. So likewise, you have to do the changes. And what we need? 12 months SM, simple moving average. Okay. So what the function is doing? Latest close divided by monthly 12 period SMA. And now I perform here some operation, that division into 100 and minus number 100. So this will become my mathematical function. So this function given in here, how to use that I have explained here. So now we can change here the column heading. So distance from 12 monthly SMA. I'll delete this. And I'm saving this. Save. As soon as I clicked on this save button, this this dialog box opened and I can change the name of that wage and description. After submitting, this will appear. Now our column are more, but by default, this is appearing to this level. Now, how to go further? I will go to this edit. Yeah, my cursor is on edit save layout. It is visible.
Yes, sir.
So I will click here, edit save. As soon as I clicked on this edit save, this gone into a gray color. Now here, these dotted dots are appearing. 3 dots, 2 dots, 1 dot. Okay. So I will go to on that dots and I will drag this like this. Okay. After dragging to up to last, this is still in gray. Then again, I have to click here to save the layout. Now I am saving the layout. I have saved the layout now. So these columns are appearing now. First is the symbol, second is price, then what is the percentage change for the day. Then if we need here percentage change weekly, I will go here on edit. I will add one more column here, percentage change, and from this latest to I will click here or for monthly, and I will rename this column to weekly percent change. Percentage change weekly, and I will save this. I will submit this. Now that column is appearing at the last. If suppose I need this column right near this, then I again go to edit. I can drag this column, this like this. I will drag this to here and I will place that there, and I will again save and submit. Now that last column was coming here. This was a percent change in this stock, and what is the daily RSI, what is the 10-day simple moving average, 20-day simple moving average. These are appearing at a glance. Whether my screen is visible, I am getting some message for internet connection.
Yes, sir. It is visible.
Okay. So all data I had, whatever data we want, that we can get here, which is available in this site. So if suppose I'm taking a decision based on 10-day moving average, I will check what is the 10-day moving average and what is the current price. If current price is greater than 10-day moving average, I will stay in that. If suppose I am taking a decision based on 20-day moving average, I will check this 20-day moving average and current price. If current price is greater than 20-day moving average, I will stay in that. Likewise, if suppose I am an ultra long investor, I will check monthly 12 SMA with this current price, and I will take that decision. Or I can add here, instead of I need suppose 50 weekly 50 period SMA. Here on this blue icon, if I go to here, that is showing me duplicate column. I will duplicate that column. It is duplicated and column 14 is appearing. From here latest, I will change it to weekly. As soon as I changed here latest to weekly, this has automatically changed to weekly. SMA weekly close 50 week. So I will edit this column name to 50 week SMA. Now observe here, though I am using some small letter and capital letter, but when we go to the wages, yeah, this column heading, it all appear in only first letter will appear in capital and all will be appear in small letter. This column we have added here, 50 weekly SMA. If suppose that price is above 50 week SMA, then I need not have to get out of that. So I will compare 50 week SMA with price. If that is above that, then I can stay in that. We can see the chart of that stock from here. If I click on this symbol, it will take me to the chart. If I am an ultra long investor, I will check this chart, and from here I can select whatever moving average I want and I can edit the period. See, this is a monthly chart. We can select period from here and range from here. So I am checking the 8 years monthly chart of this particular stock. If it is not as 12 monthly moving average, I will stay invested in this if I am a ultra long investor. If suppose I am a medium term investor, I will look at 3 years and weekly chart, and I will choose 50-day moving average. Yeah, and instead of this 12, I will use 7-week moving average, 20-week moving average, and 50-week moving average. 7-week moving average, I will use exponential, and other two, I will use simple moving averages. And I press here, update the chart. As soon as I press the update the chart, this will come. So here are the symbols. We can see here this color that is depicting EMS 7, this color green that is depicting simple moving average 20 period. The chart is weekly, so these moving averages will be based on weekly. This black line will be for 50 period moving average. This chart is for weekly, so it will be weekly moving average. So if I am a medium to long term investor, I will check whether this chart is breaking 50-week moving average. No. So as far as it doesn't break this moving average, I will stay invested in this. So where you are entering, that is also important. And then from where you are trailing that. So trail such stocks. So coming again back to dashboard. At a glance, we can check all this. If suppose my number is large, I am holding 20-30 stocks in my portfolio. So I can scroll down and see the numbers here. And there is one more function, download. If we go here on this, download now disappear. Here download will appear. I go to here download. It will give me option to download this into a CSV file. I can download that in CSV file and analyze that in Excel. So, madam, up to what time I can continue? What was the schedule? 6:15 to Atharva, what is your schedule time? 7:30 to 9?
So
Okay,
it's
7:30 to 9.
Okay.
7:30.
Yeah. Okay. So we have still 28
Yeah,
minutes.
take your time. Don't worry about my time.
Okay, yeah. So this is the fun. We can monitor our risk with the help of such a dashboard. Whether it is useful, surely yes. As we are professionals, we are more comfortable with checking numbers in a tabulated manner, in a table format. So we can take our decision. So this is how to create the dashboard. Then I will share my PPT again. I'm going to PPT. So here we were. So other fine tuning points we will see in online demo. So now the PPT is visible. Yes.
Yes, sir.
So like this, we can develop our dashboard. Going forward. Now, along with the risk management, one most important thing comes, that is portfolio sizing. See how people in general tendency, how the people invest in shares. हाँ चलो ये अच्छा लगा, इसका 100 ले लिया, वो अच्छा लगा, उसका 200 शेयर ले लिया. Instead of going by that way, if we yeah, just a minute. Yeah, I'm just checking whether all these things are clearly visible on mobile or not. Yeah. So portfolio sizing is also matters. How to do the portfolio sizing? If suppose I'm not an expert, then what I will do? I will invest my investable capital. I am not using the word total capital. What is my investable capital? I will divide that capital by 20 number. So I will take entry in 20 stock of equal value. Say if my portfolio is of 10 lakh rupees, I am a retail investor and my portfolio, my capital is 10 lakh rupees, 10 lakh rupees capital, then I will divide this 10 lakh rupees by 20 number, then it will come to 50,000 each. So while entering into any stock, at the entry point, either I will deploy this full amount at a time, or I will deploy 25%, 25%, 25%, and 25%, or I will deploy first 25%, then again 25%, and then again 50%. How this deployment can come? If suppose there is a pattern and this is the pattern breakout, after this pattern breakout, this stock has gone up. I will invest here on the confirmation of breakout 25%. If that retested here and again going up, again at this level, I will invest 25%. And when it is giving me super confirmation, I will invest 50% here. Or if suppose I am taking a tracking entry in this stock, so on the breakout level, I will invest 25%. Here suppose that breakout line, it has retested here and it is shown a positive signal me to going up. I will again invest 25% here. And when it is going to this level, I will again invest 50% here. So this is a type of pyramid, or you can invest 25 here and 25% here, and when it is going up, again 25% here, again it is going up, again 25% here. So that is called a pyramiding. So you can do that way also. Now If I have capital of 10 lakh, I am investing in 20 shares. Each entry is 50K, 50,000. So I am I am taking a stop loss, defining my risk appetite as a stop loss of 10%. So on individual entry, this stop loss will be 5,000 rupees. 10% of 50,000, that will be 5K. And if I compare this 5K with my total capital, total investable capital, that comes to 0.5%. That's why stop loss is also important, where to put the stop loss. See, as soon as your stop loss triggers, quickly exit from that stock. I have seen many cases, mark my word, I have analyzed many cases where that person has crores of rupees capital and he has sitting in this bull run also. Those people are sitting 20 lakh to 40 lakh portfolio level loss. They are sitting in loss. So if your total portfolio in a bull run that is in loss, then what you are doing? What is your risk management? How you will do this? As a professional chartered accountants, we always tell our clients, we advise them various things. One out of that things is opportunity loss. What we are doing? We are sitting on loss and not exiting that on time, and we are losing opportunity to invest in good stock which are running and make a profit from this. What is the time lost? However we think about that? If yes, then you might have been exited from the loss making stocks and you will be stay in the profit making stocks. So think on this very, very, very seriously. Don't wait in hope. मेरा भाव कभी ना कभी आएगा. Don't go into that. That will increase your losses only. If suppose you have a solid study that due to this investment factor or this factor, the depreciation cost has gone high and the company is making losses, that's why the result is not good for this quarter, but this capacity expansion will give benefit from so and so quarter. In such case, you can invest partial amount either in SIP way or 20%, 20%, 20% in some staggered manner instead of investing 100% capital at one stage, and ride that when that story gives its result. In that case, it is okay. But for that, you need to study that stock in very deep. Second thing, treat your stop loss as your capital protector fund. As I given in that example of the palm, the first pair of the finger that was get ruptured and it has started uh, gangrene has started going into the palm. If we cut that at the first instance, then we can save our full finger and as well as our palm. Otherwise, we can lose there are chances that we may lose a good amount of capital in the hope trade. Then yeah, ride the winners without any price target. See, as a professional, as soon as the person who does the technical study and fundamental study, he suggests to his friend any stock, boss, this stock is very good on this fundamental basis or on this technical basis or combination of both techno and funda. Immediately the person asks you, boss, what is the target? कहाँ तक जाएगा, मुझे कहाँ बाहर निकलना है? Boss, instead of going for the target, just go manage your risk. Whether target is in our hand? No. Do we have lakhs of crores of capital? No. That capital is with the DI and FI. We are just a small investor as compared to them. So manage your stop losses, stick to your stop losses, treat the stop loss as your friend, treat the stop loss as your insurance premium to protect your capital. Don't run for the targets. Trail them. When that stock is going up, trail them. I made a mistake latestly. I accept that in case of Premier Explosive, it has given upper circuit of 20%, upper circuit of 20%. I had taken entry at the level of near about 430, 439 with a stop loss of 300 something odd. Yeah. That has given 20% to upper circuit and then given 10% upper circuit. Or with, yeah, 10% upper circuit, and next day it has touched the 10% upper circuit and it was coming down. So at the level of 764 with a profit of near about 72 to 74% exited from this stock. But I have not followed my set rules. It has not breaked the 7 EMA, it has not breaked the 10 SMA, it has not breaked the 20 SMA. But due to the fear, because on the basis of news, the company's annual turnover is around below 250 crore and it had got order of 550 crore around, approximately, exact number I am not remembering. That company got that order and that stock was going up madly. So here I exited. I thought that I can get that on further correction here and I will again reinvest in that. But that was my mistake. After that 764, it has again gone up, closed in green, and next again it has given upper circuits. So if anyone can check the chart, what is the current price of Premier Explosive? Just a minute, I'm checking the chart. Premier Explosive, I am sharing the chart of Premier Explosive now. What happened? Not Google, not Google. Presentation is visible?
Yes, sir. Presentation is visible.
Minute, I try to share the Google. So see here, I'm going to now daily chart. Now chart is visible? Yes, madam?
sir. Yes,
Yeah.
sir.
On this candle, I have exited. What has happened? On this day, it was in red, and next day, it has given Next day, it has recorded 9%, and again 9.64%. Again, it has there was a profit booking, and again it has given a 10% upper circuit, and it is going up, up, up. Approximately from this to this level was around 24%. So this is the lost opportunity. So stick to your rules. Stick to your defined rules until and unless that exit signal is met. Don't exit from that stock. This is lesson to learn from. So now presentation is visible or still?
Yes, sir. Presentation is visible now.
Okay. Yeah, then there might be some lag in online. Okay. So write the winners without any price target, trail them to the maximum possible level with your trailing stop loss. Increase your trailing stop loss. So suppose earlier you were trailing it with 20 SMA, now trail it with 10 SMA. If that shooted up very up, then shift that 10 SMA to 8 SMA, 7 SMA. Then 50% winning ratio will also give you very good returns, which can beat twice the inflation. If you are a day trader, don't risk more than 5% capital in a single trade. Keep your stop loss of 1% only. Cut the losses quickly and ride the winners with risk reward ratio of 1:2, 1:2.5, or 1:3. Book partial profit on 1:2 risk reward. This is for day trader. This is not for positional investor or long-term investor. And trail the balance position. Now, what is the conclusion from this? Follow your portfolio sizing and allocation rules. This is most important. See, you can diversify your portfolio in different sectors. Make that rule. Don't put all eggs in one basket. You can allocate your fund in different assets. To some extent in gold, to some extent in mutual fund, to some extent in direct equity market. Likewise, to some extent in land. Then allocation rule. Don't allocate full amount of capital in a single stock. If suppose that goes down, then your capital may vanish as early as possible. Cut the losses immediately and let run your winners. It is a golden rule. Then stop loss must be followed to protect greater or larger damage to capital. Follow your stop losses. Follow your trailing stop losses. Follow your system. Make a system, and according to your system, stay in winners. Exit from the laggards and losers. Don't be in a hope trade. Finally, some quotes. These quotes are from not these quotes are not mine. These are from Mark Minervini, who is a good trainer and trader from US. With each buy order I enter, I know the exact price where I am going to sell at a loss if things don't work out as expected. So first determine where you will exit if things don't work out as you expected. Don't ask for target, ask for stop loss and follow that stop loss. I define the price level before I get in. So define your stop loss before taking entry into any trade, whether it is an investment, whether it is a trading bet, then you can make money or you can make excuses. As Nanda sir said in his opening remarks, लखपति बनना बहुत आसान है शेयर मार्केट में, provided that you are already a करोड़पति. If you do not follow your system, if you do not follow your stop losses, if you stay in hope trade, then आप करोड़पति से लखपति जल्दी बन सकते हो. और अगर आप अपना रिस्क प्रॉपर मैनेज करते हो तो आप करोड़पति से और बड़े करोड़पति बन सकते हो. You can create huge wealth if you do not lose more. So now the forum is open for question and answer. I am running out of time. It is 7:33. Madam, if there any question, we can
Yes.
quickly take 2-3 questions.
Yes, sir. So there are two questions, and first, let me tell you that members are really enjoying listening to you because there have been consistent comments in the comment box that they are enjoying this session and they want you to continue more. So,
Thank you. Yeah.
sir, there are two queries related to the charting dashboard. Kamal Garg is asking, can we add option of chain data in this dashboard?
Option chain data is not available in charting. You have to
Okay.
subscribe for other sites for that.
Okay.
And option chain data, either your broker can provide you free of cost,
Mhm.
or if you are going for other sites, then you have to subscribe for that.
Then there is one more query from CA Keval Shah, who's from Surat. He says, he asked, does the price keep changing automatically daily in that charting dashboard?
Yes, if you are not a paid subscriber, then with a delay of 5 to 15 minutes, it gets changing. And if you are running it after the closing, after closing of the market, it will give you the closing prices.
I hope that answers this question. So there were just two queries, sir. So
Okay.
thank you for such a fantastic session, sir. It was such an engaging and insightful presentation, and your knowledge and passion truly shone through. And all the participants must have been benefited from the session today, which highlights about risk management, why is it important to manage risk, simple moving average, use of minimum and maximum functions, and understanding of portfolio using charting in the real-time environment, portfolio sizing, and your tips about stop loss and quick exit, etc. So thank you, sir, for your valuable time and insights.
Yeah.
Thank you so much, sir.
Thank you, madam, and thank you all listeners for the patiently hearing me. And this is my Twitter handle. You can ask me your queries, not stock specific queries, but from this session, if you have any query, you can DM me. My DM is open. Thank you. And with this, we are ending this session. Thank you to the Committee of Financial Market and Investor Protection for giving me the opportunity to share my thoughts with the auspicious audience. Thank you very much.
Thank you, sir. And
With this,
let
I am
me-
stopping my sharing. Yeah.
Thank you, sir. Now let me take an honor in introducing the second speaker of the day, C. Athar Apteji from Thane. He is a CA, CFA, and CMA. He is involved in wealth management, investment advisory, and algorithmic trading. He currently functions across various investment verticals and leverages technology in his operations. Previously, he was the CEO and director of Devharsh Infotech Private Limited, a security printing company. He has a comprehensive experience in wealth management with a specialized focus in algorithmic trading, finance management, business management, and project costing. He has 9+ years of experience in active market trading. Currently, he is also a managing committee member at Thane branch of WIRC of ICAI. We wholeheartedly welcome you, sir. Over to you, sir.
Hi everyone, wish you all a very good evening. Thank you, Yakiji, for that wonderful introduction. It is my honor and privilege to be here in front of all of you and to get this opportunity to speak on behalf of the Central Committee for Capital Markets and Investor Protection. It is a small request to Yatiji and other coordinators. Once I start sharing, I will not be able to see you all. I'm not able to see any other participants either. So if there is an issue with the audio or anything of that sort, please let me know by talking to me, right? So without any further delay, I'm starting to share my screen and my presentation. Can you all see this? Yatiji, is this visible?
Yes, sir. Your screen is visible now.
Okay, fantastic. I'll start myself. So hi everyone, good evening once again. The topic that I'll be speaking on is long-term investing using business principles. The basic idea that I'm trying to drive through my presentation over here is that we are going to be focusing on buying a business. Right now, what exactly does that mean and how will we go about it? I'll be sharing all of that with you shortly. And the first part is, of course, the disclaimer. I am not a SEBI registered investment advisor, and during the course of the presentation, I'll be giving few real life examples of listed companies. Kindly do not construe it to be any sort of investment advice or stock tip or call of any sort. Right. So kindly do your own research and have an advisor consultancy from a SEBI registered investment advisor. So this is a short agenda that what we'll be covering today. Ghanshyam sir has very amazingly covered the risk aspect. There will be a few things that I'll be taking from this presentation also, but this is the broad agenda that we'll be covering today. The first point that I want to cover over here is the difference between investing and trading. Right? What happens is a lot of market participants are not clear as to what is the difference between the two of them. The first thing I would like to cover over there is time. A trader generally concerns himself with a shorter term time. That can be, as short as, a few minutes if he's a scalper, and it can go to few months if they are a swing or positional trader. An investor generally has a very long term horizon, 3 years, 5 years, 7 years, 10 years, can also have a perpetual holding in particular stock. The next differentiation are the tools. A trader generally likes to study their trading calls from technical analysis, price action charts, etc. And for an investor, the annual report, the fundamental analysis, and all of those things are Gita, Bible, Quran, everything, right? The next part is a very important part that I'll be covering in detail later. That is the efforts part. Being a trader is a full-time job. If you are doing something in your life that is not trading and also doing trading side by side, it is a suicide mission, right? It's something not I would suggest if you are contemplating a career in trading or if you're already doing some sort of trading. Trader is a full-time job. Investor, you can do investments without being full-time involved in it. How we will cover it shortly. The last part is the most crucial differentiation between a trader and investor. A trader is concerned with price. They want to either buy as it is well said, a trader tries to buy low and sell high, right? Or, to be more specific, they try to exploit mispricing or find out opportunities of mispricing and make their profit out of it. An investor, on the other hand, concerns himself or herself with value rather than price. Value is not as volatile or as demand or supply influenced as prices, right? So these two, this aspect will clearly create that differentiation between a trader and an investor. Myths of equity investing. So these are some things that we have been hearing across generations. First aspect, the equity trading or investing is very risky. It is something that only people with a lot of capital and lots of influence and lot of power do. More than risky, there is a different word that I like to associate with it, and that is volatile. investment in equities is not as risky as it is volatile. If you're investing in some sort of fixed income investment, let's say like an FD or some post office investment or PPI, your returns are more or less linear. They go in a very straight line. In equities, you will not find that linearity in your returns. Your returns, some years will be, your investment will literally double. In some years, it might go down by 30-40%. Most of the years, it will have a certain average, right? You will make good money over a longer period if you are following certain equity investment principles. So generally, it is equities is volatile, but it can be predicted over a longer period of time. Right. The second myth that we have all heard is buy blue chips and forget. And many people have very diligently followed this particular myth because it has also been successful. A lot of people have, 20 years ago invested in some big companies, the bigger names of our market, and they have very obviously made very good returns, right? But the thing is, forgetting is not suggestible because the capital invested is an opportunity cost. You might see your particular stock at a peak where it is not going to grow further, and you might miss out on some other opportunity on a stock which you should have invested, right? So you can't simply buy blue chips and forget. I think through WhatsApp forward, all of us have seen that example of Wipro. How a certain man had invested 10,000 rupees in Wipro in 1981, and today that 10,000 rupees has become some 600 crores, etc., etc., etc. Right? I think all of us have seen that particular forward. There is a part two to the forward that not many people know about that. The value of Wipro when that forward came out, sure, it was around 600 crores if you would have invested 10,000 in 1981. But in 2001, before the dot-com bubble burst, it had a similar valuation. That means if you would have sold your Wipro holdings in 2001 after investing in 1981, you would have got 600 crores in 2001. So knowing when to exit a particular stock is also very, very important. The third aspect, invest in equities early in life, and as you grow older and you can't take more risk, invest in fixed income investment. There's something many investment advisors and distributors will, hammer to all their clients. While it has some partial truth, but equities can create the maximum wealth across all investment classes that are available, right? So instead of following this principle set there, what we can do is we can have a look at what our short-term financial goals are and allocate our fixed income investments to those particular short-term goals. And the financial goals which are, longer term, maybe 7, 8, 10 years and above, we can think of investing in equities. Diversifying to reduce risk. Now, this is again a very well-known principle. Okay, you should invest in 10 stocks, 20 stocks, 50 stocks. Don't invest more than 2% of your capital in one particular stock. While that is very true for trading, in investing, this is something which is not suggested. There is a whole different slide that I have dedicated to it as we go further. So I think I'll cover that point more in depth as we go further, right? Last point, 90% of the people lose money. This is true, very true, but it applies more to trading rather than investing. 90% of traders do lose their money. The reasons are endless. But if you are completely focused in equity investing, that ratio is not as skewed against you as as this myth is. So it is true, but not for equity investing. Some of the classic mistakes of equity investing, a lot of people try to time the market. The first and second point can be read in combination. People try to time the market. Okay, now market is going up. I think I should buy a share. When the market is now volatile and it is going down, this is a bearish market. I should sell my share. Right. So people buy in the market high frenzy and try to exit the market when it has gone low. Classic examples were during the lows of 2020 and the subsequent highs a year later. It is very difficult for anyone to exactly predict what the market is going to do. If it were possible, so they would have created unlimited. So more than trying to time the market, okay, now market is low, or I should enter, or market is high, I should exit, whatever. Instead of trying to time the market, you should focus more on trying to spend as much time as possible in the market. If you have done appropriate research and you have invested in, let's say, a select basket of stocks for 8-10 years, the chances of you losing money are exponentially low compared to if you try to time the market. Right? So this is one of the biggest mistakes that almost all traders, all investors, everyone, all market participants are guilty of. Panicking after market volatility. Again, market volatility is a fact. It is going to be, it has existed for years. It is going to be existing for many years further. There's nothing we can do about it. But we should be able to study if the changes in price or the volatility in price is it affecting the value of our particular investments or not. The fourth mistake that people do is they invest on hot tips. Luckily, I've not seen it in the recent times, but up until a few years ago, I used to get those SMSs from random numbers. Okay, this is so and so stock is going to suddenly give a huge up move. You should invest, etc., etc. And all these SMSs used to come from unknown numbers and those weird named numbers, right? Never, ever, ever invest on tips like these. Or I'll go a step further. Never, never invest on tips from your friends and relatives also. Reason being, whatever research your friends and relatives may have done, right? It is something very specific to their psychology or their style of investing. And that style of investing or the risk that they are willing to take might not match with yours, right? And then when it doesn't match and when invariably the market moves against you, we think, okay, market is always giving me losses and I am going to cut my losses and exit, right? So it is highly recommended that you all do your own research. Last point is one of my favorite, confusing or interchanging trading and investment. I'll tell you what is the most favorite aspect of this particular point. I have had a lot of friends and lot of clients who have entered a particular trade and it has gone horribly against them. It has gone like 20, 30, 40% against them. So now they have converted this particular trade into a long-term investment. Okay, now let me sit on this particular stock. After a lot many years, this will come up and I will sell this off, so on and so forth. Right? So they start off as traders and become long-term investors. So one of the most classic mistakes of investing, you have to be very clear every time you enter into a particular position, if it is a trade, if it is an investment, or what it is, right? So some of the classic mistakes and few tips on how we should avoid them. I have received this query a lot of times. When people think of investment, they think it is something very complex, something that they won't be able to do, or it is something that people with a lot of tools and a lot of capital, only those people are able to do that particular thing, right? It is not true at all. The skills that you need to be a good investor are very, very minimal. The first thing that all of us should be good at is that we should be good at basic high school level mathematics. The simple addition, subtraction, percentage calculation, sanity calculation, simple things like that, right? These skills that are required after high school mathematics are simple but not very easy to do. The second thing that we need as a good investor is the psychological strength. Just a second, I think I've received some chat. Let me have a good at, sorry, not later. The second thing that we need is psychological strength. Why this is important? As I said in the previous slide, market volatility exists and it's going to exist till time forever, right? So invariably, there will come a time when market falls and you see a huge red mark on your portfolio, right? You should have the psychological strength to be able to analyze your particular position and your investment and understand whether the effects are on price or are the effects on value of your investment. If there is no effect on the value of your investment and the price has gone adverse, you should have the psychological strength to hold on to your particular investment. That is when markets go down. When markets go up and things start going in your favor, we all start thinking of exit plans, right? So you should have the psychological strength to analyze why your particular investments have worked in your favor and is it going to continue to go on working in your favor. So psychological strength is required at both the places. Third point is the most important. You should be able to put efforts into all your investments. By effort, I mean the activities involved in analyzing a particular investment is time consuming. To analyze a particular stock thoroughly at an initial phase can take you anywhere between a week or 2 weeks if you are analyzing it full time, right? And even more if you're doing it part time. You have to go through n number of annual reports, create projections for your own self. I'll be covering all those aspects. There are about 12 principles that we need to check, right? Basically, it has a lot of effort, and not many people are willing to put into that effort. People want someone else to have done that particular analysis, and they just want to write out that particular analysis and try to enter into that particular investment. So that is something which is severely lacking in most of the market participants. Effort is very important. You should have the patience to go through all those particular uh, uh, material, right? Like annual reports, other news that might come out, and any other industry that stock specific or industry specific news. Last part is patience. If you know a little about weapons, right? There are artillery weapons, there are machine gun weapons. They do not target some, or they don't have any precision target. They just keep on firing, try to create some sort of a cover for your infantry troops. Versus a sniper who patiently waits for hours, sometimes even days, to find or precisely attack their particular target. As an investor, we have to aim to be that sniper. Patiently wait for our opportunity and strike when that opportunity arises. Right? If you are a trader, then maybe you can think of being like a machine gun, attacking everything and whatever opportunity. Even though you don't see opportunity, you might think of it. But as an investor, you should have that patience to sit on cash until that golden opportunity arises for you. This is the master checklist that we'll be going through today. Something very important that needs to be done in this, if we want to analyze the companies that we take or the companies that we're going to invest. The basic idea here is that during our research, you should be able to objectively see the companies as the businesses. And in your mind, try to think that you're buying the business as a whole. Right? It creates a huge change in perspective. We'll be going through detail. We'll be going in detail through all these principles. They are basically divided into four. One is the business or rather the product and services that the company is offering. Second, about the management of the company. Third, the financial data. And lastly, the valuation of our particular company. We'll be starting with the first aspect, that is the business aspect. The first principle that needs to be checked in a business, that whatever company that we are analyzing or whatever business that we are analyzing, it should be simple and understandable. This is the most underestimated and the most underrated principle across investors. We try or we like to invest in companies that are trying to solve some complex problems, and we think that okay, this is solving some very difficult issues, and this is going to create a lot of value. The problem with that is we are not able to objectively analyze not only our initial research but also the subsequent news or subsequent developments that might come out in our companies once we have invested into it. There was a very good example given by Mr. Peter Lynch. He is one of the world's most well-known value investors. He told that people often underestimate the power of what they know. The example that he gave is that few people might work in a certain specific industry. For example, they might be working in banking or they might be working in automobile sector, right? When they are working in that particular sector, they are able to understand the business much better than what any other person might be able to do. They are also able to accurately understand the developments of that particular industry. Whenever, let's say, there is some regime change or some policy changes or anything that might affect that particular industry of that stock, they are able to easily grasp and identify how it is going to affect their business and how it is going to start affecting their particular company, right? The another good line and a really amazing line that Mr. Peter Lynch had told at that time was that you only need a handful of investments to multiply 100x. Maybe 2 or 3 investments, if they multiply 100x over a period of 25-30 years, you don't need anything else, right? So if you focus a lot on things that you know, you are going to be hugely successful. If you can see the last point, knowledge of what not to do is also extremely important, right? So you should be very clear where your strengths lie and how you can act upon those particular strengths. When I say simple and understandable, you should be able to grasp not only what products and services they are selling, but how your particular business or company is going to generate revenue, what are its specific cost drivers, and how are things changing in its industry going to change in your particular company, right? Generally, when you invest heavily in what you have a strong understanding of, it is going to yield you the best and the highest result, right? So this is a very crucial point. Not many people think deeply or focus on this particular point. So number one, your business, it should be simple and understandable. Second, it should have consistent operating history. What we mean by consistent operating history is not just seeing profits every year. Okay, for the past 20 years, I'm seeing consistent profits and they're also growing year on year. So this is having some consistent operating history. Not only should it have good profits, but they should be able to generate that profit using or selling similar products year after year. If the company is fundamentally changing their products due to few unsuccessful years, then that particular profits, I would not classify it as having some sort of consistent operating profits, right? I'll give you an example. Let's say Nestle. Nestle has been selling Maggie for, I don't know, years immemorable. Ever since I've been born, I've been seeing Maggie and I've been eating Maggie for a lot of time, right? Irrespective of how market conditions have changed, they have never had to drastically or fundamentally change the concept of Maggie or quick ready-to-eat noodles, right? Or quick-to-cook noodles, right? So that is one aspect that you should be seeing. Does your particular business have a steady track record selling similar kind of products or services? The last part that we'll cover in business is having favorable long-term prospects. The one thing that you need to check in your particular company is, does your company have a strong moat or a particular long-term competitive advantage? Now, a lot of you might wonder what is moat. If you remember in the olden era or in the olden centuries, there used to be castles. Kings used to have castles, and surrounding the castles, there used to be a water body and there used to be crocodiles in that particular water body. That particular water body that kept the castle safe is referred to as moat. So if you try to relate it to company, does your company have something which protects your company as a specific business? Does it protect itself from its competitors? Does it protect itself from changing policies? Basically, does it have a particular long-term competitive advantage? There are 3 things that we have to see over here. One is the desirability of our products and services. Second, if it has any close substitute. And third, how highly or low regulated is our particular company or our particular industry, right? So in this principle, you can divide your particular company in 2 types. One is franchisee and other is commodity. We'll be covering that in the next slide. A franchisee, your McDonald's and KFC and Burger King of franchisee. Franchisee here has a different meaning. If your particular company is the products and services of a particular company are desired without any substitute and has low regulations or no regulations, your type of company is a franchisee company. Exactly opposite to that is a commodity company. There are a lot of companies selling similar products, and the only way to create profit or create higher profit is to be a cost leader in a particular industry, right? So when I say commodity, I do not mean only metals and aluminum, steel, etc., etc. Even banking industry, insurance industry, automobile industry are sort of a commodity industry. There are a lot of companies selling it. There are a lot of substitutes, and there are good enough regulations to cover it, right? In the previous slide, I had mentioned the example of Apple. Right? If you think Apple from a franchisee type of view, it is a product which is heavily desired. iPhones and similar phone products, highly desired. There are no substitutes for iPhone. Android is seen as a separate product itself. And if you ask an Apple or iPhone user, they would never want to shift to any other kind of operating system, right? So Apple is a company, I would say, which has no substitute, and the regulations which are there are not very heavy as let's say compared to an alcohol manufacturing company or a cigarette manufacturing company or something of that sort, right? In today's time and era, there is no company or no industry which has zero regulations. There are at least few regulations that all kind of industry are having. So Apple is a really good example of a strong franchisee company. The classic problem that a lot of you, if you are doing equity research, will face is that you will never find companies which are strong franchisees. What you will find is you will find companies which are a weak form of franchisee, or you will find a company which are a strong kind of commodity. So what company should you buy? When can we buy a strong commodity? When can we buy a weaker franchisee? I'll be covering that in the next segment, which is management. So the first thing that we saw was business, understanding your company, your products, your services, their industry, the cost drivers, etc. The second aspect is another very important aspect, management. Why management is different from the other three aspects is that because we can somehow, either through self-research or through experts, we can understand aspects of business, we can understand aspects of finance, we can understand or predict aspects of valuation, right? But it is very difficult to understand humans. Humans are very, very unpredictable, right? So this aspect of studying the management, I think, holds more weight than the other three aspects. The first thing that we'll see while analyzing management is the rationality of management. When I say rational, it is not in all threadbare decisions. That is a must. When I say rational, I mean rationality in capital allocation. As per me and as per a lot of value investors, rationality in capital allocation is the most important job of management. Think of a particular, any company. At the end of a particular year, they would have generated some profits, right? The management has three options when it sees that particular profit. First is to ignore everything and keep on reinvesting that particular profit in their business. Another option is return that excess capital to shareholders. They have generated profit, they are sitting on cash, maybe they don't need that cash, so return it to the particular shareholders. And the one other option that they have is to use that particular capital generated or profit generated and try to buy other companies, which may or may not even be in the same industry, right? Out of these three options, if your particular management is consistently returning the excess capital to shareholders, that is the investment that we want to make or the kind of management that we want to associate with. We should always try to see and invest in companies whose management is trying to maximize the shareholders' wealth or trying to have the maximum efficient while doing capital allocation, right? Generating shareholders' value and maximizing their returns is the prime duty of management, is what I believe, right? Since we all are members, all of you might remember in SFM, we used to have this particular principle. We should see if the company is generating higher internal rate of return, or if the shareholder can generate a higher rate of return through their other investment. If the company can invest higher, they should focus on reinvesting and growing the company. If the shareholder can get or generate more returns elsewhere, they should try to return the excess capital to the shareholder. So there is no change from that particular principle. You should be focusing on checking this very aspect when we are analyzing our particular company. The next aspect that we need to see in management is candor, or is your particular management candid? This is a principle which is very difficult to analyze. Throughout my career, I have found very handful of companies and a very small percentage of companies who are truly candid in their reporting. So the principle overall states that you should check if the management is candid with their shareholders. What exactly are the directors writing in their annual returns? Is it something which is a true view of their company, or is it something that is just being copy pasted year after year in their particular report? Because as per management, very few people are reading it, right? Is the management trumpeting their successes and whatever they have achieved, but then not threadbare showing their failure, right? We should be having a very strong eye on all of these aspects. While analyzing, this is the most difficult thing to analyze, if a management is particularly candid or not. One simple thing that you can do is, when you are going through multiple annual reports, you can check if the management is delivering what they promise. And it is very simple to do that. You can check the annual reports of the previous few years, maybe 3, 4, 5, 6 years prior annual reports, and you can see what the management is promising, or what is the direction that is being shown by the management in those reports. And you can come back to the current time and see if those particular things have happened. Have they really delivered what they have talked about in their particular reports? And how efficiently have they delivered that or not delivered that? If they have not delivered that, have they appropriately explained why they have not been able to do that? Have they been very put forth with their failure? So this is a very simple way to check if the management is candid or not. And why it is important is because in the current annual reports also, you will see some certain directions and certain promises made by them. So it's a good approximation way, or it's a good way to know if they'll be delivering on the promises that they are making today, right? So the second aspect was candor or being candid. Third thing about management is, are they resisting the institutional imperative? This point is very difficult to explain, but what it means is a lot of people as humans try to show that they are doing a lot of things, that we are hyperactive, we are doing this X, Y, Z, A, B, C things, we are not sitting idle, we are not taking rest, we are consistently doing work, right? So in reality, we don't need our management to be hyperactive and consistently trying to do 10 different things. As I said in the first slide, you should be able to understand what your strengths are and focus on those particular strengths and try to grow your company based on those strengths. Is the management resisting the need to be hyperactive? Is the management fundamentally changing the business direction based on what the industry is doing, right? There is a classic study. I have given this funny cartoon over here about lemmings. Lemmings is an animal found in, I think, South America. And every few months, the entire community comes to a cliff and commits mass suicide. It has been a psychological case study. No one knows why they do that. But we can link our behavior to lemmings. We tend to do things that people are doing. It's a sort of a herd mentality. We want to be a part of the herd and not left out alone, right? So and management collectively are no different. If people in the industry are doing something together, they have this urge to follow that particular thing or that particular direction that is being taken by the management. So as I said earlier, this point is a bit difficult to explain, but you should be able to see if your management is resisting that urge. Okay, everyone is doing this particular thing, we should also be jumping into it and leaving our strengths behind. I can explain this with a very good example. It is from the automobile industry. If you have observed, a lot of participants of the automobile industry are moving towards EV, electronical vehicle, and or ancillaries of EV, right? In this scenario, we have Maruti, Maruti Suzuki Limited. They have said that we will not move towards EV. Our strengths are CNG, and we are going to be focusing on CNG. This is a very good example of their management resisting institutional imperative. As I said in the start, I'm not giving any stock tips. These are purely for educational purpose and just an example of what resisting institutional imperative really means. So these three aspects, rationality, candor, and resisting the institutional imperative, form your study of management. The next part that I'll be moving towards is our favorite and something we do day in and day out. The most classic mistake that investors and a lot of researchers do is that they focus only on the financial aspect of a particular business. Financial and valuation is something that has to be seen at the last. Initial things that we need to see are the first two things, the management and the business. You should be able to understand your business, and then you should be able to really analyze what your management is doing. Once you are satisfied with those two things, only then should we come to the financial aspect of it. So in financial principles, there are 4 principles that we'll be going through. The first one is focusing on return on equity instead of focusing on EPS. EPS and P ratios are very, very deceptive, and if you don't study a particular company in depth, it might lead us to making huge errors. I'll give you a really good example for this thing. Last year when I was analyzing stocks, not last year, earlier this year, in January, February, I was analyzing battery stocks. And at that time, a few friends came over and told me, Atharva, you should really focus on analyzing Exide battery. It has a P ratio of 3. To explain, when P ratio of 3, it means the share price might be 100 rupees, but they are earning 33 rupees. Right? 1/3 of their share price is being earned, which is a really high, it's a very low P ratio and very high value indicator of a particular company. And it is very desired. I started studying the company in depth, and I found out that out of the profit of that particular year, around 80% of the profit was from the sale of a division, and only 20% of that particular profit was from the regular operation. So in reality, their PE was not 3, their PE was somewhere around 15, which is acceptable when it comes to a manufacturing company like Exide. Right? So, but there are very few people who go in depth and look beyond the PE ratio. PE ratios are extremely deceptive. A better indicator of company performance would be return on equity, to see what shareholder funds have been invested into that particular company and what return is being made through their operation. Right? There are few adjustments that we need to do when we are trying to calculate the return on equity. That is, your particular company will be having certain investments, and because of IFRS and India, they are required to mark it to the particular market value. So you should be able to look beyond that and only consider those particular investment at cost. You should be able to exclude other capital gains and one-time profits, one-time losses, extraordinary profits and losses, and just threadbare analyze your ROE on the returns that have been generated through the operation, rather than just picking that figure at face value from the balance sheet or from the P&L report. Right. Last part over here is to ensure that debt is either 0 or very low. What happens is, if there is high debt in your particular company, it can create a smokescreen for your return on equity. If the company is very highly leveraged, you will see a very high return on equity. The other danger of having high debt is that your investment or your company can only go bankrupt if it is having debt. If you are not having debt in your company, there is a zero to absolutely very low chance, low to absolutely zero chance of your particular investment going to zero, right? So you have to ensure that the debt is very low. A thumb rule that I have created during my analysis is that if the total debt, long term and short term, is less than 10% of the sale, I consider it to be, insignificant amount of debt, right? Next aspect that we'll be covering is the owner earnings. In the financial metrics, the four principles, owner earnings is the most important metric that I look for. It is a bit controversial because as accountants, we are able to differentiate between P&L, balance sheet, and cash flow. And owner earning is somewhere a combination of three. Cash is king, there is no doubt about it. But we cannot just pick those figures directly from our cash flow statement and use that for our analysis. There is a very specific way of calculating owner's earning. If you could see the second point, we take the profits after tax, add back the non-cash expenses and the depreciation, and we exclude the capex that we have done throughout the year. So whatever additions that have happened to our fixed assets during that particular year, we subtract that, right? The reason being, we are trying to understand what cash has been generated by a particular business. So the last point, we'll also give adjustments for the changes in working capital. If more working capital is being allocated towards our company, or if the amount that is invested in working capital is increasing, so we can understand that more cash is being utilized for working capital. If our working capital is reducing, we can understand that our cash is getting free and cash is getting generated in our business. So we should be able to see if our owner earnings are not only consistent, but also are they consistently growing. So instead of analyzing if our net profit is consistently growing, I typically analyze if our owner earnings are growing. And this also is very useful because owner earnings is not a particular number that is being required to disclose by the company. Companies will disclose NPAT to you and other metrics to you, right? But no one will disclose the owner earnings. That's why there is no parameter like PE for owner earnings. So that's why it is very important for us to calculate this particular metric and then compare it in the form of some sort of a PE ratio, right? So instead of using threadbare NPAT, I would rather use owner earnings and compare it across the stocks in the similar industry, right? Third aspect that we'll be seeing are the high profit margin. Really good businesses which are consistently growing have this ability to convert their sales into profit. What we are looking for here are cost leaders in our particular industry, because if in the industry two companies are earning or are having similar sales, the company with the higher profit margin is going to give you better returns and is going to grow faster than the other companies. The more important point in this aspect that we need to check is whether our management is consistently working on cost cutting, or is our management having the principle of control costs in their blood. If you find companies which are, every few months waking up and saying that we are now starting a cost cutting program, or now we are going to be restructuring our costs, etc., 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 we should try to be away from that particular company and that particular management, because controlling costs is something that should be imbibed in your management thought process, right? When you are focused on controlling your costs, you will ensure that your business is generating high profit margin. So whenever we are analyzing this particular point, we have to compare the profit margin with companies that are there in our industry. So we can compare the profit margins across similar companies in the industry and check if our particular company is better or there are other companies who are having a higher profit margin, right? The last and really amazing metric that we can check is the 1 rupee test. Whatever profits are generated, some part of it is given back to the investor as dividend, and some part is retained by the company for reinvestment. It can also happen that company reinvests the entire 100% of the profit and gives out no dividend, right? The thing that we need to check over here is that for every 1 rupee retained by the company, has the company able to being able to create a similar market value for its investors? To explain this better, let's say the company has created 1 rupee of profit and given some part of it as dividend, some part of it has retained. Now, while the investor has full rights over its dividend, the investor also has full rights over all the other profit also that was generated. But they are not getting that as dividend. But they should be able to get that through the increase in the share price, which is translated into this market value. So that is one thing that we need to check, whether the market value of our company is increasing vis-a-vis whatever profits that are being retained by the company. This is a good indicator that in future, whatever profits are being retained by the company, are they going to translate in the form of price in the share market, right? It's a good indicator of the increase in market value that we can expect from our company going down the line, right? So with that, we come to an end of the financial part of our analysis. The last part is the valuation, estimating the business value. The first step here is obviously calculating the owner earnings throughout the year, checking if they have been growing consistently and at what rate they have been growing. Next, a very key metric that we'll need here is a discounting percentage. Okay, we know what owner earnings are there. We have created some sort of projection based on whatever owner earnings that have accrued in the past year. Let's say in the past 5-10 years, we have seen 10-15% growth in owner earnings. We can use that similar growth for future owner earnings as well, right? But they need to be discounted for today's value. What rate should we consider? I have strongly rejected the use of capital asset pricing method. If you remember again from our SFM days, RF plus beta into RM minus RF, right? There's one formula that we'll never forget. And we derive a particular discounting rate that our equity investment should make. I am not in agreement with that particular metric. Reason being, when you have done all the study, you have focused on an industry and on a product that you understand very well, and you have researched the company, you have researched the management, you have gone through n number of annual reports, and you have seen all the financials. If you have gone through all this effort and now you have realized, okay, this is a company that I can invest in. It is something that I have confidence on. You have automatically made that investment not risky because you have gone in depth to research that particular company. Of course, there will be systematic risk, but you have reduced that unsystematic risk by doing all this research. When you're doing all this research, so it is not very necessary that you have a very high discount rate or very high rate of return that is expected from the company. You can have a few pips above your risk-free rate. Let's say if risk-free rate is 6%, 8, 9, 10% is a good discounting rate that you can apply to the future earnings. In my analysis, I have generally used 10% as a very ideal discounting rate to discount the future owner earnings at current price. You can even go a step further and use the risk-free rate also to analyze your particular investment. The last point is buying at a discount. You can go through all the effort, be patient and put effort and find the best company with the best product, the best management, really good financial numbers. But if that particular company is not available at a discount, for example, if its market valuation is 1,000 crores and your valuation is let's say 800 crores, you are not getting that particular company at a discount. So even though it is one of the best companies, if you are a value investor and a long-term investor, it is not suggested to go and buy that particular business. It is not suggested to enter into that particular business at that particular price. Maybe we can wait for that price to be available at some sort of a discount before entering into that particular position. Obviously, as the discount percent increases, your margin of safety also increases. Why this margin of safety is required? When you are buying a particular business, you are concerning yourself with the profits that the business is going to generate and the cash flow that the business is going to generate. And you are making a projection of it, right? You cannot very accurately predict exact earnings that the company is going to generate in the future. You are making a prediction or you are making a projection, right? When you have a higher discount available to you, you have a higher margin of going wrong. Okay, you expected growth at 15%, but growth happened at 10%. If you are buying a company with a higher discount, you can afford this minor misperformance or a lower performance from a particular company or a particular investment. If you are having a very low margin of discount and the company's projected or the company's real earnings are even slightly lesser than your projected earnings, it can usually affect your investment. It can usually affect your investment psychology, right? So having a higher discount ensures this high margin of safety for you. It protects you from a downside. It gives you a higher psychological strength. There was a very good quote by Mr. Warren Buffett. He was citing an example that he bought a particular company at $140, right? And it was available at a discount. He had done his research and he purchased the company. And after purchasing, there was a turmoil in the market and the price of that particular company went down to $100 or $95. And people started approaching him and telling him, oh, now your investment has got risky. There was no significant change in the value of the company. And Mr. Buffett just asked him a question. If there is a company which is having a really good value and its price dropped from 100 to 95, did it become more safe or did it become more risky, right? So if you are confident that whatever volatility happens in the market is temporary and there is no significant change in value, this discount will offer you a good psychological strength. In the long run, the stock prices do tend to catch up with the intrinsic value of your business. But the crucial aspect for this is that you should have spent considerable amount of time in your investment. If you have invested in a good company, you have bought a discount and you have invested for 5, 7, 10 years, there is a good chance that the stock price would catch up with its intrinsic value. But expecting that to happen over a short-term period would be foolishness, very frankly. You cannot expect that, okay, I am expecting this intrinsic value, I have got it at a discount, and within 6 months it will jump to that particular value. High level of patience is required when you are a long-term investor, right? So these are the 12 tenets or 12 principles that we must go through when we are researching any and every company, right? This again, I'm telling you from the perspective of an investor and not from the perspective of a trader. All this research is centered towards finding value of a particular investment, right? So not very suggested if you are just trading, right? Basically, what we are trying to drive over here is that you should have a business owner mentality. Instead of logging in every day and checking the chart of what has happened to your particular investment, you should be spending more time in understanding what your business is doing, what it has done recently, what are its plans for the future, and what strategies the management is going to follow, right? You should have a hawk-eye vision and a view on the profits and the cash that your company is generating rather than what the price volatility that is happening, right? The share prices are going to create a lot of noise. I'll give a very funny example for this. Let's say, for example, you have a business, you have an ice cream shop, and you are doing this or running this business in a partnership. You are there, and there is a partner with you. Now, this partner is very funny. At every day at morning 9:15, it will shout a price at you. This is the price at which it is willing to buy your 50% stake. It is also the price at which it is willing to sell its own 50% stake. At 3:30, again, they'll shout that particular value, right? So every day your partner is shouting a price or throwing a price to you. This is the price that I would buy or sell at, right? They are doing it without fail every day for n number of years. But what happens is this partner of yours is throwing prices at you based on their mood. When they are happy, they are throwing higher prices for your prices. When they are sad or dejected, they are offering very low prices for their particular business. My question to all of you is, if you are in this situation, would you take this particular partner of yours very seriously? Would you really concern yourself with what prices your partner is throwing at you, or would you concern yourself with how your business is performing, how many ice creams you are selling, what profits you are generating, what issues are you going to face, etc., etc., right? As a business owner, you will be focusing on the latter and not really at what prices are being shouted at you, right? The stock market is no different than all of this. Every day from 9:15 to 3:30, prices are going to be shouted at you. If you are a business owner, let's say if you own 100% of a particular company, you would not be really bothering with what price movements are happening, but you would be more bothered with what cash flow is being generated and how it is being affected and how your profits are being affected, right? So you should have the mentality of a business owner, and you should have that thought process when you are an investor, right? You should be able to look beyond the noise that is being created by the stock market. Having said that, if you remember Ghanshyam sir's lecture, if you are trying to enter into a particular investment, the price will be a good indicator. Maybe you will be needing those risk management principles to enter and exit, right? So that aspect, although for me is of a lower significance, you cannot ignore that particular aspect, right? But the events to focus on that particular aspect should be infrequent. The higher amount of focus should be on the cash flows, on the profits, and on the changing circumstances of your company and the particular industry, right? So that was it for analyzing our company. The next aspect that we'll be looking at is portfolio allocation. A lot of people have a high number of stocks in their portfolio. They'll have 20, 30, 40, 50 stocks in their portfolio. And they'll call it diversified, and they say that there is no risk involved in that. If you are going to have 50 stocks in your portfolio, the better thing to do is not invest in any of the 50 and directly go to a particular index. Invest in some sort of either the Nifty index or some sort of thematic index like maybe banking or IT or automobiles, something of that sort, right? If you are going to be a long-term investor and if you have the time and the patience and the effort to do all the analysis that we have discussed, you should limit yourself to a very focused portfolio, maybe 5 to 10 stocks, and really dedicate your time to those particular stocks, right? Now, when we say creating your portfolio, does not mean if you have selected 8 stocks after very thorough research, we equally divide that 12.5% and invest it, right? That is not something I would suggest. With every stock, you will be able to study a probability, maybe through the discount that is offered or through the growth that you are projecting or any other factor, right? There is a certain probability that you are expecting from your investment. Your particular stock is going to grow higher. There is a 50, 60, 70, 80% probability that it will grow at this particular rate, right? If you are having companies with a higher probability of winning and higher probability of growth, you should also have a higher allocation towards that particular stock. Let's say there are 2 companies. One of them has a very high discount from its value. One of it has some certain X number of discount that is available, right? If you ask me, I would have a higher allocation, maybe 18-20% of my total allocation, or maybe 25% of my allocation towards that particular stock, and maybe a 5-6% of a smaller allocation towards a stock which I have low confidence on, or it has a low probability to win. I'll explain that with a casino example, right? If you go to a casino and I'm offering you odds on blackjack, right? In the next hand, you are having an 80% probability of winning. And in the hand after that, you will be having a 30% probability of winning. Very obviously, you should be increasing your bet size. Let's say if you are having, if your general bet size is 100 rupees, you should be increasing your bet size on a bet which has a higher probability of winning. If there is an 80% chance of you winning, you should increase the bet size. If on the third hand, when you're going to have a 20% chance of winning, you should reduce the size of your bet, right? Stock market is no different. Across this 5, 8, 10 stocks, you will find varying probabilities through your analysis. You should allocate higher percentage in the portfolio to those companies which have a higher probability of winning. Once you allocate, it doesn't mean that that is the final allocation. As the days, months, years pass by, you will see the probabilities change or probabilities getting realized, right? As and when these things change, you should be able to change the allocation in a portfolio. If you have, any of you have observed, institutional investors, right? They do not enter into a particular investment in one shot and do not exit a particular investment at one shot, right? For example, let's say LIC is investing into a particular company. If they have a certain allocation and they think, okay, now we need to exit from here, they do not remove the entire allocation. If they were having 10% allocation to it, they might reduce it to 5, 4, 3%. But they very seldomly exit totally from that particular stock. What they are doing is they are adjusting their particular portfolio to the probability that has now realized or the circumstances that have now changed, right? So even though it's a game of probability, you should be aware that continuous adjustment might be required to your allocation, right? So as I said in the previous example, blackjack or poker player, if your hand has a higher chance of winning, you should be betting higher amount on your particular bet. Fourth point is very important. If you remember the skills that are needed in investor, I mentioned that you should have patience. Now, what happens is, I'm also guilty of this thing. When I'm sitting in front of the screen and there are, endless opportunities out there, and I'm also a trader alongside an investor, I cannot resist the urge to enter into a position. I want to consistently do some sort of trade, right? I can tell from experience that it is difficult to control those trading urges, right? You always want to be a part of this game, right? But what we can do is we can create a difference, or we can create a distinction in our capital with prime bet and action bet. What I meant by action bet is that this is a small allocation of our portfolio, maybe 1%, 2% of our portfolio, that is dedicated to just trading urges. Okay, now I want to be involved in trading, so let me take this XYZ position. So you can allocate this very small portion, 1-2% of your capital, to action bet and have the entire chunk of your capital towards the prime bet, in which you have done thorough research and you have waited for the right opportunities and the right price and the right value and the right discount, right? So it is very important, if you have a hard time to control those trading urges, that you create this distinction between prime bet and action bet, right? Last aspect that we need to cover over here is the turnover ratio. Turnover ratio here means that how frequently we are churning our portfolio. If the turnover ratio means 10%, right? So 1 out of every 10 stocks is being churned over every year, right? So what we have to focus in the turnover ratio is try to have as low as possible, entering into a new stock and existing stock, right? The lower turnover ratio you have, the lower cost and lower time allocation you are going to be requiring for your particular portfolio. And these turnover costs and time allocation can have huge cost impacts on your portfolio return. So it has been observed for the past 50 years that there was a statistic that when you have a focused portfolio and lower turnover ratio within that portfolio, those portfolios generate the maximum amount of return, right? So this was it with regards to portfolio allocation. with regard to principles and other things, other ideas, we have reached an end of our session. I'll just be quickly going through two case studies, two companies that I have researched. Once again, I am not recommending them as any sort of tips or anything of that sort. This is purely for education purpose and a research that I've done. I'm just simply sharing that particular research with you. So the company here is GM Brewery. The first thing that we'll see in its business is it's simple and understandable. So what GM Brewery does is that it manufactures Indian-made Indian liquor or Desi Daru in simpler words, right? In its business, it is having high rate of turnover, very high. I think around 60 to 70 times rate of turnover is what is being seen. And the main cost driver is rectified spirit, right? So it's a fairly simple business to understand and study. GM Breweries over the past 30 years have sold only 5 products. A product named Santra has been their highest selling product, right? So using these 5 products over a large number of years, they have consistently generated profits and they are consistently growing their profits. Long-term prospects, alcohol is a never-ending requirement. The company has a monopoly, virtual monopoly in Mumbai, Thane, Palghar, and primarily they are marketing in Maharashtra, right? The one thing that they do not have in long-term prospects is regulation. Alcohol industry is highly regulated. There are also a lot of substitutes which are not from an established company like GM Brewery. So these two things are an issue, you can say, with this company, that they are not having a moat with them, right? It is one of the most premier established companies when it comes to Indian made liquor, but there are a lot of unorganized players also in this particular market, right? When I was talking about regulation, there is one thing I forgot to mention. In the alcohol industry, or in the case of GM Brewery, the indirect tax that is being collected from them is almost 75% of their sales. So very high regulations from the government. I think at 23 close, they had 1,700 crores of turnover, gross turnover, and out of that, around 1,200 crores or 1,300 crores was the indirect tax that they have paid, and only 400 crores was the net turnover, right? Only 25% of their total sales is the actual sale price that they are realizing. Next aspect about management. Management, is it rational? Not according to me. The reason being is that they are neither reinvesting in the business nor returning the cash back to the shareholders. The profit and cash, whatever they are generating, is a very high cash generating business. It is being reinvested in financial instruments, mutual funds, FDs, bonds, government securities, etc., etc., etc. And a very high allocation is being given to those particular investments. My problem with that is those particular investments will generate maybe 6%, 7% return. They are predominantly into risk-free investments. I believe that the shareholder or the investors can earn a higher return from those particular capital, right? So the rational decision there would have been to declare higher amount of dividends and buybacks and give back to the shareholder. In candor, there is a very funny thing that I observed in GM Brewery. The first annual report that I picked up, it was brilliant. They had threadbare given out what problems they were having and how they were going to tackle it, and issues that they were facing with high government regulations, etc., etc., etc. They were that threadbare given everything. But when I started reading the second, third, fourth annual report, I realized that those particular paragraphs are copy pasted. For the past 5-10 years, they had the exact same thing that was copy pasted in their annual report. The problems were similar across all the years, right? So I think there was not much candor from the management in that particular example, right? Of course, they were reducing margins during the COVID period, and that aspect was well explained by the management, right? Third part, raising institutional imperative. Yes, they are doing that. They haven't in their 30-40 years of business. They have not fundamentally changed directions of the company. And in terms of external acquisitions, also, they have not done any sort of uh, company buyouts or buying out their competitors, etc. So they have resisted that particular institutional imperative very well, and they are very focused on their strength and the products that they have been successfully been able to market. Right. Third aspect comes to financial. The return on equity currently is at 16%, and it is reducing year on year. But the reason for the reduction is the allocation towards financial investments that they're doing. If you remember the previous point or the previous slide, they had a lot of profits and they were reinvesting all that profits in financial investments. The financial investments are returning 6-7% year on year, right? And it is way lower than the ROE that the business is generating. So that's why, on an average, the allocation towards financial investments is increasing. If I remember, out of the 500 crore capital that they have deployed, only 200 crores is being 250 crores is being utilized for their operations. All the other capital has been parked in some sort of financial instrument, right? And that is reducing their ROE. Owner earnings have been high and they have been consistently increasing, almost 15 to 20% year on year. The profit margins are also from their core business are very high compared to the other competitors in their particular industry. For the 1 rupee test, in the last 10 years, they have retained around 365 crores from the profits that they have generated. And the increase in market value in these 10 years have been 930 crores. So almost 3 rupees generated for every 1 rupee retail. So that is a really, really good ratio in this particular example. Lastly, GM Breweries, when I did the valuation using the owner earnings and the projected owner earnings, I came at a conservative valuation of around 3,000 crores. So what I do is I see the projected earnings in a high growth rate environment, in a no growth rate environment, and also in an average growth rate. So even in a very low or no growth rate environment, it had a very high valuation. And it was at that time available in the market for 1,000 crores. So there was a good 66% discount that was available for GM Brewery, right? So that was one case study. Next case study was about Exide Industries. I would not go through all of this in depth, but there was one very important point that I wanted to drive in Exide Industries. If I ask, whenever I've taken this session and I've asked the audience, what is the industry that Exide is involved in? So everyone knows it is in batteries, right? Lead acid batteries. But Exide Industries also had a division which was into life insurance, and that is something which was highly unexpected and something that barely anyone knows, right? So when I see something like this, okay, this is supposed to be a battery company, but then it also has a life insurance division, and both of them have no connection at all, right? I automatically start rejecting that particular company in my mind. But what happened in Exide Industries was that there was a change in management. In the previous year, the MD and CEO was changed. And one of the key aspects that the current management did was within 6 months of taking over, they have disinvested from their life insurance business and they sold their life insurance business to HDFC Life for 5,000 crores. So if you remember that PEOL example, my friend came and told me, it has a very low P ratio, only 3x, right? That the reason was that they had disinvested in their life insurance business. And if I remember the figure, their market price at that time was around 160, 170, and EPS was somewhere around 50, 60 rupees. Out of that 50, 60, 40 rupees was from selling of the life insurance business, right? Cost cutting program was mentioned. We are starting a cost cutting program. Generally, this is not something I like to read, but since it was a new management that had taken over, that was one concession that I had given in the case of Exide Industries, right? Financials were decent enough, not very good, not bad. But the issue was that Exide was not available at a discount. In my conservative valuation, and even in good high growth valuation, it did not beat the current market cap, right? So even at high growth valuations, I came around 15-16,000 crores of valuation, and it was available for the same price. So no discount. In fact, the company was available at a premium. So if you see, this goes against uh, 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 the principle of seeing only PE as the valuation metric. It had a PE of 3, but it was having a discount of minus 66%, or it was available at a premium of 66%, right? What should I do as a retail investor? Uh, Allocate a certain amount of our investment of our capital to emergency funds and 6 months of living expenses. We should also have allocation towards our short-term financial goals, and for the long-term financial goals, we should stick to equity. If you are not having the time to research whatever you have mentioned, you can think of investing in equities through index. The benefit of indexing is that an index will never go bankrupt. A collection of n number of companies, right? Maybe one company goes bankrupt, you will never go bankrupt. So there is a good safety to your capital. Of course, there will be volatility, but there is no risk of that particular index going bust, right? And you'll enjoy the benefits of equity return, right? Lastly, find a trusted advisor, or you can find a trusted advisor. Thoroughly check if they are SEBI registered, if they are having the requisite licenses, if they are a mutual fund distributor, have they taken the requisite licenses, etc., etc. And also think logically on whatever advice that they are giving, right? If you are finding a trusted advisor that you can trust on, it is not a bad option to do. So with that, we have reached at the end of our lecture or the session. You can find my contact number here and you can get in touch with me for any queries henceforth as well. For the time being, the session is over and I'm opening the floor to queries and anything that you might have to ask from me.
Thank you, Atharv sir.
Yatiji, are there any queries from the audience?
Sir, it was such a comprehensive coverage that I think all the doubts were answered automatically. So we don't find any queries right now, although number of participants are huge. So let me quickly check it once again.
If anyone has any queries, so we can solve it. We have a good 5 minutes.
There is one query, but I don't think so. It is related to what you have covered. Gaurang Somani is asking if you can brief about Polycab chart.
I unfortunately cannot do that because it would be a very specific stock query, and since I'm not a SEBI registered advisor, I cannot give any specific stock advice. And another thing, charts are also not my area of expertise, right? So unfortunately, I won't be able to talk about it. I'm extremely sorry about it.
It's okay, sir. There are no further queries, but all the members are really happy having attended today's session by both of you. And I really want to extend my appreciation for the time and effort you invested in preparing for today's session. And you have briefed us about investment in trading, myths of equity investing, the skills of a good investor, management, financial valuation, and business owner mentality. Portfolio allocation and case studies of GM Breweries, Exide Industries. The presentation was really comprehensive and informative, and it was great and really insightful session. Atharv, thank you so much.
So thank you so much, and I would also like to thank our committee on financial markets and investor protection. I would also like to thank CS Nandaji and Ghanshyam Joshi for giving me the opportunity to speak here on behalf of the National Security. Thank you so much. It was a privilege and honor to take this session for all of you. Thank you.
Thank you, Atharv. Thank you, Ghanshyam sir, for being with us, and thank you everyone for being with us in the session today, despite being such a busy time of the year. Thank you.
Thank you, everyone.
Thank you.
Nice
Thank you.
presentation, Atharv.
Thank you.
Well covered all aspects.
Thank you.
Yeah.